Good afternoon and welcome to the Conduit Holdings Limited investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Neil Ackett, Executive Chairman. Good afternoon, sir.
Good afternoon, and I'm joined here with Trevor Carvey, Group Chief Executive, and we also have Elaine Whelan, Group Chief Financial Officer, in case there's any questions on finance at the end of the session. So, Antonio, let's go on to the first slide. So this is our investment proposition. Conduit is a pure play Bermudan reinsurer. It does not write direct business. Its value proposition is based on targeted underwriting. We underwrite property, casualty, and specialty. Specialty is classes of business such as marine, aviation, energy, political violence, etc. Me and Trevor started the company in 2020. We believe we've assembled, or particularly Trevor's assembled, a team of really strong underwriters. We have a highly efficient operation, a very open collaborative culture. Just behind this boardroom there is the underwriting floor. It's all open plan. There is a high level of communication. We have a management team, as I said before, with proven track record, and more the use of data is coming into the reinsurance market, the ability to analyze underlying portfolios of risk. And as a reinsurer, we have access to a lot of underlying portfolios. So data plays a very big part of our business. One of the aspects that I think makes Conduit particularly attractive is that we raised the money in 2020. Our first underwriting year was 2021. So we do not have exposure to back year legacy issues. It's a clean, strong balance sheet, and investments also. The mantra is keep things simple. It's a AA rated portfolio, short duration, average duration I think is about 2.5 years.
Around there, yeah.
We can talk more about that in the Q&A, but with that I will pass over to Trevor.
Thanks, Neil. Morning, everybody, or afternoon if it's in the UK, no doubt. So some summary points here to kick us off, which really encapsulates the trading update that we've announced in the RNS today. Gross premiums written 356.8 million. That's up 28% year over year versus the first quarter 2023. That's good growth in the reinsurance space that we're in. There's still an awful lot of the market that we see before us that is worthy of us deploying capacity into. The growth for us, as we called it out previously, property and specialty particularly are offering more attractive areas for us. So 37% growth in property and 31% in specialty are obviously driving that. And as I say, we're targeting the classes and the sectors where we see the best returns at the moment. But generally, the market is still very attractive for us. On risk change, or risk-adjusted rate change, I should say, that's 3% overall, net of inflation. And that's across the blended portfolio of renewals, +5 in property, down 2 in casualty, and up 2 in specialty. In terms of those, that's the rate change net of inflation that we've got on our renewing portfolio. We obviously have new business as well. We're adding to the portfolio in the quarter. It doesn't form part of that computation, but overall, we're still seeing a positive environment. Casualty is interesting because it's around the edges there where we established a core book of business going back to 2021 when we started the business. We've built on that year over year as we've grown that casualty portfolio. Some of those renewals were showing a bit of rate weakness, hence that's why you've seen that -2%. but we've traded through that. We've done some optimization of the portfolio, and there's new that's been added. The key for us year over year on casualty is to ensure that in the overall casualty division, we don't see combined ratio deterioration. So essentially, we're looking to trade that casualty book through, and we are still growing it, but maintaining that margin on the overall portfolio. And that's what we're being able to achieve to date. Trading environment, I touched on this already, but we refer to it as an underwriter's market, and that's very much how we see it. Within the divisions of property, casualty, and specialty, we have a whole host of subsets. And that's the important point with a multi-line reinsurer. We have 3 big divisions, but within those, there are lower subsectors. And the underwriters are finding still a number of those classes are very attractive. And the general rating level across all of them is in a very good position. During the quarter, active quarter for industry events, number of Nat Cat losses as well out there. For us, they're well within planning expectations. And there's certainly, there's pockets of positive impact on the rate that we're seeing within those. Mature business now in the 4th trading year. For us, it's been a question of building the platform, and if you like, in the first couple of years, getting to that stable state. And really, over the last 2 renewal seasons, I think the business and the underwriting trading teams have been in a position where we've got significant relevance in the market. All of our 3 divisions are trading very actively with the large clients and the large broking houses. And we're seeing, which is really what we're expecting, this our 4th year, still an increasing flow of business through our front door, which is a great position to be in, because for us, the big mantra that we put out when we put the business together was that you need a wide spread of business to be able to select from. And as we published in previous announcements, we have a healthy review rate, shall we call it, for every 10 risks. There's a lot that we review that don't make our hurdle, and a smaller percentage do. So for us, that's a good position to be in. And as long as we've got that strong funnel of distribution, it means that we're in a very strong position to select as we go forward. The last point is an important one for us. Non-admitted partnerships. That's basically a sector in the US, in America, where a class of carrier, which is referred to as non-admitted, has been on a very steep rate and terms and conditions increase, so improving market over the last 3 years. And we called that out very early. We built some very key, strong partnerships there through 21 and 22. And a lot of the growth that we're seeing at the moment is coming out of that area where there is a very healthy margin. It's been referred to a lot in the industry press, but I think for us as Conduit, we called that out very early and have been active in that space for now getting into our 4th year. Antonio, next slide. Slide here, which is, I think, informative over, the history of the company over the 4 years, shows what we've written on a cumulative basis since the company came into inception. So written just over $2.2 billion of premium. And the value in this slide is that you can see the property, the casualty, and the specialty are all playing their part. So the rate of increase in specialty has been larger in the last 3 quarters, but over the whole piece, there's always that focus on having a balanced portfolio, and that's really key for us. You're not going to see this portfolio suddenly taking a big skew out to write a predominant portion of, for instance, cat business within the property space, which imbalances the portfolio as an example. We're always going to keep the relative parts of the pie, if you like, in some sort of proportion so they balance, and there's a diversifying factor there. It means the company and the performance of the portfolio is more robust around absorbing shocks and losses that come through, and the portfolio is in a position where you're not overextended in any one country, region, or class, and that's really important for us. And also, probably just a last point here is that given that the way that the reinsurance treaty business is accounted, particularly the quota share that we write, that has a development pattern and an earning pattern where the premium comes in over time. So that's the reference there to a significant pipeline of unearned premiums is still there from our 22-23 portfolios in particular, that is still earning through and coming through in 24. Okay, next slide, Antonio. So these next 3 slides are really around the specific divisions of property, then casualty and specialty, and just showing a bit more colour around how we see these sectors. So as we said on the first slide, 37% growth in property, premiums written going up to 217 million Q1 2024. And on the right-hand side is that progression of the rate change using the base case as year-end 2021, and then what we've seen risk-adjusted coming through to where we arrived at in 2024. And you'll see this also on the casualty and specialty slides. We started in 2021, but there was already in train a rate increase environment. So what we've been seeing in these rate increases that we've been reporting year on year, it's really on the back of the years that are compounding to this point. So you start to see some of the sectors now which even start to flatten out, things like casualty at the moment. And for us, it's still sitting on a relatively high part of the cycle. So overall, across the 3 divisions, you'll see this in the other 2. They're at, I won't say at career highs, but they're certainly at relative highs over the course of the last 10 to 15 years. So the industry at the moment that we're trading in the reinsurance space is a strong place to be active and deploying into. Just one comment at the bottom that cat capacity increasing is a slightly dampening effect as we get into the mid-year renewals. Catastrophe reinsurance, excessive loss reinsurance, there's a big renewal season that's due up in the US particularly, and that as we go into the hurricane season, a lot of those reinsurance contracts renew through May, June and July. There's more capacity that's come into the market and sitting around, particularly at the very remote end. It's not really where we play. We're not big writers at that part of the spectrum, but there's more capacity that's evident and has come into the market. And the top end or the higher remote end of catastrophe reinsurance will certainly see some rate fall off, some rate drop off this coming mid-year. I think we referred to that in our call earlier today. It's an area which we'll observe, we'll watch it. We're not massively skewed or heavy in that space, but it's something which we're very comfortable trading through this mid-year. Next one, casualty. Yes, a casualty, single-digit growth, 6%, which even though we saw a negative 2% on our renewals, which is the point, we're still very comfortable growing that marginally over the quarter. As I referred to earlier, we see a lot of new business, an awful lot of new business, which we pick and sift our way through. And when we rank that business up, some of those have been very attractive for us to write in the quarter. So we've added some new, which is contributing to that 6% growth in casualty. But actually, particularly with the January renewals, form part of the first quarter, we did let some casualty business go at the margins, relatively small amounts, but we, if you like, re-optimized the portfolio, added some newer, better blended margins, and cycled out some of the business that we thought was showing signs of weakening earlier than other classes of casualty. And that's a perfectly natural course of action that you'll see us actively participate in, looking at the portfolio month to month and quarter to quarter. And we're very comfortable with new business that we see that is a better replacement for current portfolios. We're happy to optimize the portfolio within that. And it's a healthy activity, which a lot of reinsurers talk to, in my experience, but often don't carry out. But we're very comfortable making sure we maintain those margins in the portfolio. Next slide, specialty. So good growth here. Specialty classes cover a very wide spectrum. There's certain things that we don't do, particularly motor, mortgage, political risk. We don't trade in those spaces. They are very acute classes where you need some very specialized expertise and very specific capital allocation tools. In our experience, those are areas where we can't punch above our weight, so we avoid them. I think it's a healthy discipline, knowing where your strengths are as opposed to where they're not. So the team is happy growing within our specialty arena, 31% growth in specialty, still showing good risk-adjusted rate change. And if you see from 2021 across our blended renewal classes, it's up 13% over that time, which is a really good place to be. There are various losses over that period of time in the industry. Ukraine came through, obviously, over the course of the last 18 months. There's been a lot of talk of that in the market. That caused price increases through in the aviation space, which we're relatively small in, but it's an example of where the market does react. And then there's the Baltimore Bridge loss, which is still very much being ascertained to the scope of that with the industry. So there's still a lot of work to do in terms of where that loss will ultimately go to in the market. But that again will probably cause some uptick in rate within the marine specialty classes as that loss comes to, if you like, fruition in the market over the course of the next few quarters and indeed over the course of the next year or so. So the specialty market does react. We're active in it, but it's about being disciplined, knowing your strengths, knowing where to play and where to keep your powder dry. I think the team's done a very good job through the course of the quarter in growing that specialty. And to a large extent, that's probably just a final word, especially for us, is essentially lower in the nat cat contributions. There are some specialty classes that in the industry can be written, but do bring large natural perils accumulations for us. We try and focus on those classes that essentially are complementing our property cat portfolio and doesn't add to our overall corporate catastrophe maximum loss accumulations. Next slide. Financial highlights. So this is summarising really within each of the divisions where we are: property, casualty, and specialty. 78 million gross written premiums, and you can see a lot of that's being done through that property space. The 36% change we referred to before. A lot of rate coming through there. A lot of new business in the specialty space, as I say, which helps to diversify. And casualty, you can see, as I referred to before, we're still growing that marginally, but recycling some of the thinner margin business and putting in some of the newer attractive business. We referred there to no event loss individual in the aggregate within the quarters had a material impact, and that's a reference both to the Baltimore Bridge and also the series of natural perils losses, which are still quite prevalent. A lot of them don't make the big industry press, but a lot of losses through parts of America, tornado, hailstorms, and whilst they're not the front page hurricanes, there's a lot of insured loss out there in the underlying, particularly the property market space, where natural perils losses are more frequent, and certainly it's something which we track. But we plan and budget for those expectations largely. So for us, you incur those losses within the portfolio, but there's nothing outsized for us. And that goes for losses also in Europe. There are Italian hailstorms, which again, you'll see that being reported quite significantly through the European reporting season. But again, for us, they're well within expectations. Okay, next slide. Neil touched on this at the start. Our quality investment portfolio. For us, it's about capital preservation and making sure that we got the liquidity to support the underwriting side of our activities. Low risk strategic portfolio allocation. You've got the split of that there in the asset allocation at the end of March. Total investment return in the quarter, 0.5%. Yes, higher yielding portfolio coming through, but that's offset by the increase in the market impacts from interest rate changes on the mark-to-market valuations. You'll see that through, as we've seen today, pretty much in a lot of the quarterly reporting that's coming through. That's a trend that's just been there through the interest rate changes in the quarter. Portfolio duration, Neil touched on this earlier, then the split of that within. We do have a consideration of the ESG factors in the management of the investments. So that's still a key part of how we review and how we manage the allocation of the portfolio through the ESG sector. And it's something which we're very active in with our managers. Okay, so final slide for me. I think then we move to Q&A now.
We do, yeah.
Yeah. So we've spoken about the growth in the quarter, but it's just a kind of a comment here to what happened in April, and then actually through beyond that. You know, it was a good April for us. That momentum continued, and we're certainly still continuing to see in the mid-year renewals a very healthy trading environment and rating levels. As I say, it's a following wind largely. You know, we refer to it as an underwriter's market, and the point there is where we see clients doing a really good job and the market's still in our favour, we're really comfortable growing the shares and developing those positions appropriately. And the appropriately really does refer to keeping the balance in the portfolio. And the underwriters are certainly always have that within their key drivers where they allocate capacity. All three divisions playing their part, property, casualty and specialty. They've all had a good rolling 12 months, but certainly a good quarter. And even the areas of casualty, which is showing signs of softening, we've got a really good hold on the performance year over year and what our underlying core partners are doing in deploying in that space. Strong balance sheet, as we've said, you know, we've become increasingly relevant with clients. We continue to expand the business with those clients that we are comfortable in the way that they deploy their own line sizes and their own portfolios. And the low 80s undiscounted combined ratio certainly continues to emerge within our overall portfolio. Final word, as I think I've said, you know, it goes without saying, high quality new business is what we look to focus on. It's not an easy task. You know, anybody that tells you can sit in the reinsurance market, open the doors, and all the business that flows through is top notch is not being entirely truthful with you, I would say. So the team do a really good exercises of sifting through a very broad portfolio. What's distilled out of that is probably the word. Is a core book of business which we're really happy supporting through. So I think that's probably it from me, Neil.
I think we can now move on to Q&A. Thank you, Trevor. Hopefully that gives you a feel. One would stress that we don't report results on a quarterly basis. This is a trading update. Our next results will come out at the end of July for the first half. But with that, Antonio, let's pass into Q&A.
Neil, Trevor, thank you very much for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard. As you can see, we've received a number of questions throughout today's presentation, and thank you to all investors for submitting their questions. Perhaps if we dive straight into the Q&A, the first question that we have here reads as follows. Can you give us your view on the overall profitability of the market today, and where do you think it's heading, and the growth you envisage for Conduit Re in this market environment?
Okay, so kind of a general question, high-level question. Profitability in the marketplace. I think it's sector and class specific. If you look at class of property, for instance, you know, on a global basis, you know, trying to boil the ocean here to a degree, I suppose, but there are very specific areas where our view is, and I think if the industry is honest, there are better returns than others. If you look through Europe on the property space, some of those margins there, and we see a lot of business, a lot of those margins leave a bit to be desired, to put it mildly. You know, we see it, we put it through our model, and it's really not worth deploying materially into that space. If you look at property that's presented to us through the US, generally, the ground up business, i.e. the non-cap business, is showing some really good margins. That's a function of the way that, to a large extent, the regulation and the insurance carriers are licensed in the States. They're much more regionally focused. And within that kind of spectrum, you're able to focus in on some really good opportunities. Casualty is interesting. Casualty is class specific. So if you look at casualty, areas such as public D&O, directors and officers, and professional liability have started to, certainly over the last 12 months, we've seen rate softening appearing more and more in that space. We follow it, we track it, we know what our clients are doing to manage that. But that's class specific. There are other classes within the casualty space which are still holding up and presenting very well to us. Specialty, I would say, again, class specific. Specialty has a very wide spectrum of short and long tail business within it. There are a whole host of, if you like, marginal returns that sit along that scale. There's probably too much in this session now to go into that into great depth, but the value in the specialty portfolio that we see in the way that it refers into overall blended margin and profitability, providing that's not contributing, as I said, to large natural perils accumulation, which has a capital cost for us, but providing it's bringing the reverse of that, which is individual risk diversification with a margin, that's a really good space to be. And I think probably the wrap up for me here on this one is, I think you'll see us, as we referred to in some of our messaging from the last 2 or 3 quarters, pushing on in that specialty risk space, and that brings good diversification. It brings good new margin, which sits within our overall portfolio very nicely.
Thank you. And just turning on to the next question here, which has 2 parts. The first part reads as follows. Can you, in layman's terms, run me through what the difference is between gross premiums written and reinsurance revenue? It's the terminology as much as anything.
Sure, happy to take that one. We were an IFRS 4 reporter, and IFRS 17 came in last year, and we implemented and adopted that standard. And reinsurance revenue is an IFRS 17 term. Gross premiums written doesn't really exist under IFRS 17 anymore, but we've chosen to keep that as a KPI in our financial reporting so that you can see how things are going in kind of old school money, if you like, and still able to see the growth there. Reinsurance revenue is akin to gross premiums earned, but that is netted down further by ceding commissions, and then there's a smaller adjustment for non-distinct investment components, which is essentially profit commissions, or a component of profit commissions. So it is a derivative of gross premiums written, but if you go back to kind of old world accounting, it's gross premiums earned net of ceding commissions, essentially.
Thank you. And the next part of that question reads, is your build out of staffing and admin costs now sufficient from further revenue growth?
Yeah, that's an interesting question. Certainly when we put the original plan together, we saw that trend line in terms of operating expense to broadly the percentage where we are now. In the round, we are very scalable from here. So we've got a good, robust systems and operations divisions that are supporting the underwriting. Underwriting teams have been largely, I would say, kind of fully staffed, certainly for the last 18 months. We're adding ancillary support underwriting personnel lower down in those teams. So it's really about processing the administration of the policy count as it grows. But the business as it stands at the moment is in a very scalable state. You'll see us still adding personnel to it, so the headcount will go up. We'll still continue to invest in systems, but as a pure metric, and the percentage cost of it relative to the premium, we're at that level where I think we said we would be trending to when we put the original plan together.
Yeah, so 5%. I think also very importantly, we have the balance sheet to sustain that future growth without needing to issue new shares or debt. And now that we've matured, we actually have on top of the existing balance sheet, the potential of retained future earnings.
Thank you. The next question here reads, given the focus on profitability and underwriting discipline, how are managing the balance between growth and risk, especially in high growth segments like property and specialty reinsurance?
That's the conundrum that all reinsurance leaders, managers run every day. That's exactly the point. I think a lot of it goes to our approach, and one of our underwriters referred to this. I think a good way of thinking about it is, we manage the exposures through the front door on the way in. There are reinsurance models out there where companies and balance sheets are more comfortable taking very large positions on the inwards business and then seeking to solve that problem, if I call it that, through retrocession and as it's passed out and laid off. That's not what we do. So the portfolio, growing the premium, growing the scale of the business, but keeping always in mind the need to balance the portfolio through the front door, which is kind of a way of thinking about it as we write it, is really important to us. There is no quick answer. There is no golden arrow that you can point at it and say that's the way to solve it. It's just hard work, and it's continual evaluation of the portfolio as it evolves. And I think we do a good job of that. And some of my comments around specialty and risk being not cat related goes to a big part of that. We're very conscious of if we're selling a product, we want to get paid for the component parts, and that's really important to what we do. And if we're selling a specialty policy that's got some natural perils in it, we want to make sure we get paid for that. The industry isn't always good at doing that. And products do get sold whereby there are coverages, I won't say hidden in there, but are included that are perhaps not priced. And that's a big part of what we do. Every policy we write, we strip out and break it down into its component parts. And that then goes a long way towards sort of answering that question. I think, that's how we measure that we're getting paid for the exposures that are building up in the portfolio and making sure they're balanced.
I think also where we've seen the opportunity in the portfolio from the very beginning of the company, we've chosen to write more quota share than excess of loss, which also helps us to manage the volatility around our combined ratio as well.
Thank you. The next question reads here, regarding casualty lines in general, it seems as pricing is not keeping up with underlying legacy reserve inflation. What are the odds of casualty prices picking up in the future?
I'm not sure I'd like to put odds on it. I think the general comment I would make is that the industry is really alert and alive to it. If you look back in that soft block year of years coming up to 2019, probably, sort of 2013, 14 up to 19, they are really starting to hurt the industry. We obviously came into being 2021 and onwards. So I'm not sure when I put odds on it, but certainly when every client presents to us now, which is interesting, I've been around doing this in some shape or form for 40 years, as has Neil. And the big change and shift that I've seen over the last 4 to 5 years is every single presentation and submission we get from clients now has in there right up front a reference to how they're coping with managing and tracking underlying claims inflation. Some do it better than others. Some charge, we think, more appropriately than others. Everybody talks about it, but some do a better job. And one of the things which we're really keen to do, and we refer to it, in optimizing and changing some of the shares on our casualty portfolio, is making sure that those that say they're charging for it can demonstrate they are, and if they are, we're happy to support them. But certainly everybody is aware of it, and it's certainly front and centre, particularly in the casualty lines.
Thank you. The next question here reads, is an underwriter's market somehow different to a hard market?
Shall I take that one? Yeah. Go. Essentially, it's the same. A hard market is one that probably at the higher level is typified by pure price, short-term price increases which are dropped in and are suffered by the market almost kind of ubiquitously. And a hard market is then referred to as, well, wherever you go, everything's up, it's hard market. Underwriters market, I think, is more nuanced. And what we're trying to convey there is that there are really good pockets where that hard component exists. But it's a blend also of understanding what you can do with terms and conditions. So we've got a lot of tools at our disposal where if we like the rate, we can also do things with, we can still negotiate and put limiting factors on terms and conditions, move some deductibles, we can put some exclusions in contracts. And it all has the effect of, from an underwriter standpoint, enabling that underwriter to influence and improve the margin. They are essentially, they go hand in hand. An underwriter's market, I think we're trying to convey that at the moment, generally prices are up and are good, but you're able to still impose and negotiate in improvements to contracts through the softer areas. So that's, I think, what we were trying to convey.
Thank you. The next question here reads, are you adopting any new technologies or innovative practices to enhance underwriting processes?
Yeah, very much. It's been a feature since we started that we're obviously legacy free. We wanted to make sure that we were digitized, broad concept, but digitized as much as possible, that we weren't stuck in, for instance, just standard spreadsheets forever. And the structure, the infrastructure we built enables us to get at that data and to do things with it down the line, and for it to be more accessible, malleable, and add more value to the business. So what we've done in our short time is really focus on making sure that the systems that we've got are able to talk to each other, communicate with each other, and be very much in the digital world. And for us, as AI, as a case in point, so it's a big topic, starts to become more and more possibly relevant and certainly more visible in our space. The infrastructure that we've built is something with something like AI could look at and can look at. There are tools around which we're in the process of considering at the moment that can do a lot of good work around your existing data sets, interrogate that, look at it, and produce some outcomes. And I think for us, the reinsurance treaty world, we acknowledge that each transaction is very different. There's a lot of non-uniformity in data, non-standardization of data. In the way that we've set up our infrastructure, I think we've got a better chance of getting that into formats that we can then do things within, like in the world of AI. And the value that we see as a leadership team is that those tools can add significant speed and clarity and transparency to the underwriting decisions and other areas of our business when we're managing costs, for instance. So exciting times. We're set up to do it, and it'll take some time, I think, for the industry to really get to grips with it. But for us, we want to push on and have the teams do work on that as we speak.
I think this question touches on one of the most fundamental changes that I've seen during my career. If I go back to my broking days, you were reinsuring someone, quote share, you take a share of the underlying account of your client. But it was a blind follow because the data was not accessible and could not be analysed. And now there is access to data, analysis, data ingestion, all of these things are really coming. It's a very fundamental change.
Thank you. The next question here reads, on a GWP/surplus basis, it looks like the company is roughly writing on a 1-to-1 basis. What's management's appetite on increasing this ratio?
Yeah, I think that's not necessarily how we would think about our business and our potential. A lot of it comes down to business mix. And as Trevor's talked about, there's a lot where we limit volatility and our exposures to natural catastrophe, and the heavier excess of loss nat cat programs tend to be a heavier capital requirement. So it really is something that's driven by our business mix.
Thank you. The next question here reads, are you looking towards expanding into emerging market regions? What opportunities do you see in this area for Conduit, and do you have any plans down the line for this?
Without being too broad, I'd say that we have very limited ambitions in the emerging markets. Provide if the information and transparency is limited. So there's a rather clunky way of saying we see a lot of risks from emerging markets. We are open to considering business from those, more on the short tail space of property and specialty. But we have pretty high levels of data requirements we require to evaluate risks. And a lot of the emerging market submissions we see and portfolio presentations just don't have that level of data and clarity of data. I think they're getting there. There are some of the territories are better than others, but it's generally quite a long way from what we require as kind of a base set of data in a certain format to what is presented in a number of cases. So it's a shame because it obviously is largely diversifying. But as a reinsurer, you really need to understand and be clear on the risks and exposures you're bringing on board. So yes, we are interested, but it's really a function of the data being brought up to a level that fits our own organisation.
And also our margin requirements.
Yeah.
Because some of those territories do not support our target margin.
Yeah.
Neil, Trevor, Elaine, thank you for answering all those questions that you carry from investors. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to yourself and the company, Trevor, could I please just ask you for a few closing comments?
Okay. Thank you all for attending today. It's been a good chance for us to share more in terms of where we are on the journey that we've been on. I think probably the only words I would kind of leave the room with or the call with is, momentum's good. The market is in a really good place. You do have to pick your way through a broad range of classes, but there are a lot of opportunities. And for us, I think we see the year ahead as being a really good space for us to continue to deploy into. Thanks.
Thank you, everyone.
Neil, Trevor, Elaine, thanks for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and I'm sure will be greatly valued by the company. On behalf of the management team of Conduit Holdings Limited, we'd like to thank you for attending today's presentation and good afternoon to you all.